Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Drew Day. Remember, new shows are posted every Monday and Thursday. You can subscribe to our show on iTunes and YouTube. Now, if you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Now, today I spoke with Drew Day, co-founder and president of MicroQuant LLC. He's a quant. He's created indicators for both retail and professional traders. He's created automated strategies and been involved with a few hedge funds. So in today's show, we talked about what Drew went through to learn how to become a quant. He tells us his process for creating indicators and then turning those indicators into automated strategies. Drew tells us how he identifies when an automated strategy is in a drawdown versus when he needs to look to change that strategy. He explains how certain indicators work better on certain markets, and Drew goes over the good and bad that he's learned working in hedge funds. Thank you for listening, and please enjoy this episode. Drew, how you doing?
I'm doing great, Anthony. How are you today?
I'm doing good, my friend. I'm really excited for this show today. You're a very interesting guy. You're a quant. You've created your own indicators, automated strategies, been involved in a few hedge funds. And one of the most interesting things to me that I learned about you when we met online was that you're from Naples, Florida. And I thought that was pretty interesting because I live in Naples, Florida now. And most of the people that live here that I'm friends with in Naples, Florida aren't even from Naples, Florida.
That's true. That's very true.
So I'm curious, a guy like you, born and raised in Naples, Florida, becomes a quant, creating his own indicators, automated strategies, involved in hedge funds. How did this all begin for you?
That's a really interesting question, and I guess I have kind of an interesting story because I never planned to be in the hedge fund space at all. That was never part of my goal growing up. But it just so happens that when I was in college, I think I was a sophomore in college, I went to school in Tennessee, and I got an internship at a hedge fund in Naples, Florida, of all places. And that's really where it all began. I came home from college and put myself in a hedge fund office, got them through a regulatory audit, and that's really what started to open up my eyes to learning a lot more about the hedge fund space in general and quantitative analysis and trading.
What did you do to educate yourself on becoming a quant?
Well, being a quant is something that is kind of a lifelong thing. It's something that there's a lot of books out there on quantitative algorithmic trading. There's a lot of people that will tell you that you need to get a CFA or a CMT or different things of that nature. And what I've always been the type of person that has to learn through trial and error. And so a lot of what I've learned inside of the space has been through just grabbing books and just consuming the content and learning more and more, not just the theory side of being a quant, but actually the real life application of putting it into practice inside of hedge funds. And sometimes we're right and sometimes we're wrong as quants. But the thing that really has stuck out to me the most is, it's largely based on statistics, probabilities. And so knowing how to be secure, even when you're making decisions that have a probability of failure, has been one of the biggest takeaways for me in my career. And but I would just say, Anthony, that the biggest takeaway for me, the thing that I have done the most in my career to learn about how to be a quant is twofold. One, through a very disciplined, rigid process of studying. It takes a lot of studying to be a quant and to be good at it. But then you also have to have the real world application. And that comes from a lot of battle scars, making great trades, bad trades, developing good systems, developing bad systems. It's a little bit of both. There's no, I think, just clear pathway to becoming a quant, if you will.
I bet you there's a lot of people out there that are probably like, Anthony, I don't even know what a quant is. I mean, why don't you give everybody just that quick definition of what a quant is?
Sure thing. It basically, quantitative analysis, quantitative trading. We call ourselves quants, and what we do is we take advantage of today's technology, modern technology, and mathematics. And what we do is we create algorithms, and these algorithms look at a host of factors for trading. The way that we do it specifically inside of my company is that we're always looking to take advantage of the price action, looking for ways to exploit a trend and take advantage of the trend. And so the logic inside of the algorithm is then coded in such a way that it generates trades that remove what we like to call ego, emotion, greed, and opinion. So we're kind of nerdy, and we're totally okay with that, where we like to develop algorithms with advanced probability statistics and different types of algorithms to help generate trading decisions for us. So we're 100% systematic in the way that we approach the markets.
And I know that you trade a lot of futures, but are you only trading futures? Or are you trading stocks and maybe even cryptos these days?
As far as the portfolio of what we trade, we actually trade primarily futures and options. We don't really do a lot in the cryptocurrency market. But we do trade stocks, options, and futures as our primary focus.
I love that you're trading futures and options as your primary products, but why? Why did you choose futures and options over everything else?
I like futures for several reasons. One of the things that I learned through my career path was just the diversification, the true portfolio diversification that you can get with using managed futures inside a traditional stock and bond portfolio. So futures has kind of been the market that I started with. To me, futures are just very simple. I think they make sense. I think when people look at adding futures into their portfolio, it can smooth out their equity curve over time. And that's one of the things that I really like about the liquidity that the futures markets provide for you and the diversification. So it's probably something that's the first thing that I traded. And it's just a market or an asset class in general that I just love to trade.
I want to talk about making your own indicators because, I created my own indicator as well. I had specific reasons why, and I've only created one indicator. It was just because I wanted to find something that fit my style better. Now, you've created multiple indicators and automated strategies. Why did you go down this path of creating your own indicators versus choosing the million other indicators that are out there?
That's a really good question. I think that there's a genuine curiosity about the markets in general, that the markets are fascinating to me, to my company, to my business partners, and the people that I work with on a daily basis. And so one of the things, our company does a lot of things, but one of the things that we do is educate traders on how to trade futures and options. Primarily, we really deal with a lot of active day and swing traders. And one of the things that we have found by working with thousands of traders around the world, and mind you, some of these traders are not very experienced. Some of them have been trading for maybe 5 years or more, and some are advanced. But the common thread between all three of those types of traders is they're always looking for an edge. They're always looking for a way to simplify the markets and communicate something that is easy to identify. And so when we as a company develop an indicator, the first thing that we're looking for is how can we simplify this process for the end user. And we've done that for both retail and institutional traders. Some of our technology, some of our indicators are, we have several patented indicators, but we also have some on Bloomberg's terminal for the institutional traders, and then we have a host of retail platforms that we work with. But the process that we go through is all driven behind the desire to help, really kind of like a Sherpa would help somebody climb up the mountain to get to the top of Everest. That's the way that we look at developing indicators.
Take me through the process a little bit of the mindset you have when you're sitting down going, okay, I want to create an indicator. Like what are the steps that you are beginning with and then ultimately get to the point where you go out and create that indicator?
It's a really good question. I think it depends on the type of indicator that we're looking to develop. But generally what we do is we look at a lot of the common indicators that are out there and what their objective is. And we'll study that indicator. It could be as simple as an exponential moving average. And we'll take that and we'll study it. And we'll look at all the different pros and cons of the indicator. And we'll trade. A lot of times we'll trade that on paper, but sometimes we'll trade real money with it. Just getting a better feel of really just immersing ourselves inside of what that indicator is trying to do. And then we'll look at some of the inefficiencies inside of the indicators or how traders struggle to actually generate good trades with these common indicators. And then we'll look to build something either as an enhancement to the indicator or as a completely new indicator if it solves the problem. And so what we'll do is all of us as a company, all of the traders and the analysts that I have on my staff, we'll sit there and we'll look at this together. We'll go through a robust research and analysis period, and then we will actually trade it for probably a good 30 to 60 days. Just so that we can see how the indicator is working in different market environments. And sometimes, you're in a primary trend or a secondary trend. We're technicians, so the way that we look at the markets, we're always looking for the trend change. And we want to see the indicator work in a variety of different markets and timeframes. And then we go back and we back test it, just looking at some different trading strategies. And then after it's gone through all of our stress testing, all of our research, then we will take it to a core group of our students that have been with us for a long period of time, and we'll actually work with our students, which is kind of unique, and get their feedback. So after we're done with that step, then we'll take it to the broad market to help retail traders primarily.
Okay, so you create these indicators, and I know from speaking with you, then you turn some of them into automated strategies where they'll just go in and automatically execute for the setups that you're looking at. Nowadays, this has become such a big part of the industry is that people want automation. And like I said, you've been doing this for a long time. So after you have the indicator or the idea, walk us through the process a little bit of how you then take that indicator and turn it into an automated strategy.
Okay, sure. So just putting this in layman's terms, what we'll do when we find an indicator that shows promise that can generate algorithmic-based trading signals, what we'll do is we'll actually look at different markets first. So we want to look at not only a specific group of markets, because these algorithms, sometimes we'll develop a specific algorithm to a market, say like crude oil, for example. But other times what we'll do is we'll take an algorithm that's more universal that we'll use inside of multiple different markets. So maybe it's trading crude, maybe it's trading corn, maybe it's trading wheat, maybe it's trading the bonds, different things like that. And so our proprietary process for doing that is it's probably somewhat boring for a lot of people to listen to and very quantitative in nature. But to simplify it down for most people listening to this is that what we do after we get the indicator and we turn it into an algorithmic trading system, it's either going to be specific to a market or it's going to be more specific to a portfolioed approach. And when we do that, we have to run a series of stress test. We use a lot of Monte Carlo analysis. We run risk of ruin calculations. We go through and we literally run it on several computers. And we have to have server for this because we use so much programming power when we do this that sometimes it takes us several months to perfect a trading strategy. And but when it's finished, when we're finished going through that process, what we're able to do is we're able to come up with a system and show an in-sample and an out-of-sample analysis of the algorithm or the system. And we're able to determine, based all the way down to the minimum amount of capital that a trader or an investor should put into the system in order to generate a specific profit target over a period of time. And then we actually sit there and we look at what the anticipation of the drawdown is going to look like. We're also going to be able to calculate one of our favorite things to look at is what's the risk of ruin. Because one thing I've learned in trading, specifically in the quantitative side, is that the risk of ruin, it's very easy if you don't know what you're doing to burn through that capital very, very quickly. And so you want to have a better idea of how the system's going to operate over time. And you can do that by looking back, obviously doing back testing with today's trading platforms. There's a lot of great tools out there on even retail platforms today, which you can back test. But what we do in our proprietary process is very in-depth. And then after we've gone through all of that analysis, we're able to look forward and do a forward testing and see how it should react over time in the future, if that makes sense.
It does. And something I want to pick your brain about a little bit is you mentioned that there's ways to determine how the strategy will perform and also what a drawdown would look like by doing back testing. You know me, Drew, I'm a point and click guy. And one of the reasons is it's been hard for me to get involved in automated trading is because I struggle with believing in the backtesting aspect of things because I'm someone who believes that the markets are always changing. So I'm always trying to adapt my execution. Now, I always use the same indicator, but my years of executing my strategy, I have felt that has given me an edge in my execution because I could identify different times when it's working better than others. And you know, that's helped me, you know when to trade more aggressively, less aggressively, or not at all. As a quant who's sitting there watching these automated strategies, how do you know if it's just in a drawdown once it goes live versus maybe it's just not working? Because that's something that for me, when I was watching some of the automated stuff that I was doing, I'd watch it start losing money, and right away I'm going, man, I got to take this thing off. It's not working. I want to go right back to point and clicking again. So it's been a challenge for me. But you do this, and you have the patience to sit through these drawdowns, but identify how it's in a drawdown versus it's not working. And what do you do when it's not working? Do you tweak it or do you go back to the drawing board?
That's a great question. And, so it's going to be different for every market. Algorithmic trading, quantitative trading does take a certain degree of an iron stomach and the ability to handle your emotions very, very well, because you can be way up and you can be way down. It can be very volatile through both extremes as you're trading. So if we develop a new strategy, and then how do we determine if we're in the middle of a drawdown versus a system that's basically just completely going defunct? Most of the time, what we're going to see inside of our systems, the way that we do it, there's a few things, maybe some tricks of the trade, if you will. First of all, when we look at these systems, we're only trading one lots on these systems to start with, even when we go live. And the reason that we do that is that it's a lot easier to manage a one lot inside of an algorithm than it is trading larger size. We scale into that size over time. But if we were to put a system out and automatically went into a drawdown, that happened to one of the systems that we have a few months back in crude oil, actually. And so we look at all of the statistics, and we're able to look at a range, and we're able to see, based immediately on where the market's dropping to, if we're in line with our parameters or not. And if we're outside of the range of those parameters, there's a few things that you can do. You can either pray that the markets are going to come back and you're going to catch a trend and recover those losses, which is not something that we like to do, or you can hold. You can hold the position and see how it goes. That's oftentimes what we do is we use some of our patented technology inside of our systems. And one of our patents that we use, it's called value charts, is a market analysis technique that determines if a market is trading overvalued or undervalued in real time. And we also have another patent called price action profile, which determines the degree that the market's overvalued or undervalued in real time. And so what we're able to do is use that as a filter to kind of filter out some of the noise and to avoid some of the chop. So that's probably not directly answering your question without getting into some of the proprietary things that we do. But most of the time we have a pretty good read based on the statistics and the range on where we think the drawdown should go. For example, if we have a system that's developed to handle a $25,000 investment and we anticipate that the drawdown should not exceed $8,000, and all of a sudden we find ourselves in a $9,000 drawdown, we know there's a problem. And so at that point, a lot of times what we'll do, if we end up going down to that $9,000 mark, we're $1,000 below what our anticipated drawdown is, we're going to look at the market first. We're going to look at the primary trend. We're going to look at the secondary trend. We're going to break it down into short-term trends. We're going to try to identify what is going on inside of this algorithm before completely shutting it off. Most of the time what we're going to do is this is our philosophy. Most of the time we're going to hold to the algorithm, and we're willing to accept a little bit more loss because most times in these systems, you might generate 2 or 3 losing trades before you catch a big winner that comes back and exceeds. But if you keep hitting the losses and you keep exceeding the drawdown expectations, then most likely what we do is we shut off the system and then we go back and we do further analysis before putting it live again.
Do you have specific indicators that you create for specific markets because you believe they work better for those markets? For example, let's just say, treasuries, we like to use fibs, or crude oil, we like to use momentum indicators. Do you have certain markets classified that you're building indicators around those markets? On
a proprietary basis inside of some of the systems that we have, yes. What we develop for retail traders, no. Generally speaking, when we work with retail traders, we design indicators that are universal to all markets, that work in futures markets, the equities, cryptos, options, all that stuff. We want it to be as universal as possible because it's a lot simpler and it's way more value for them than getting into some of the advanced stuff. Now, that all being said, we do have a few tools that we've designed that are specific to different types of markets. So one of our indicators is called the SRT indicator. It stands for Spread Retracement Tool, and that's used for spread trading futures specifically. But you could also use that in spread trading, pairs trading in stocks as well. But it's really designed for the futures.
Yeah, see, that's one of the advantages of being a quant, Drew, is that you could look at these markets and you could say, look at these indicators just flat out work better in these markets. And then you could focus your time and energy on creating specific indicators for those markets. It's pretty cool. Let's talk about the hedge fund space a little bit. You've been a part of a few, and talk to me about the world of hedge funds. And you've said, look at Anthony, there's a lot of good and bad I've learned. And give us a few of those examples, please.
Absolutely. So I've been a part of multiple hedge funds since I started, and let me start with some of the good, and then I'll end with some of the bad, because I think a lot of people could learn from this, especially if they're aspiring quants or if they want to maybe create their own hedge fund. Just some things to avoid. But starting with the good, one of the greatest things that I learned early on was the importance of systematic trading. There are a lot of great benefits to it, and there are also risk with it. But the thing that I'd say about the advantage of systematic trading is it really can create a lifestyle for you of freedom. And what I mean by that is when you develop these algorithms and you have a core group of algorithms that can be trading for you, you don't have to sit in front of your computer all day long. It's fantastic. And you can really take advantage of multiple different trading styles inside of being a quant. You don't have to just be a long-term trend follower. There's a lot of different styles that you can use inside of a hedge fund. And so through my career, I've had the advantage of working with funds that had differing objectives and different trading styles. So I've kind of seen a broad range of trading styles, everything from long vol trading all the way to relative value to just a lot of different things. And so from the standpoint of what I think is the greatest lesson is I think that the best way to beat the markets 100% hands down, in my opinion, is through systematic trading. There's just no way, in my opinion, that you can always, first of all, there's no trader that's always going to be right. And a lot of times when you are basing trading decisions based on emotion, greed, and opinion, you have a bias that's wrong. And that bias can really cost you a lot of money. Whereas when you have a system that's generating the trading signals for you, first of all, it's faster execution. Secondly, it filters out a lot of the noise. And so, there were years back in my career where, we had multi-million-dollar months using systems where discretionary traders were getting hammered because they were making decisions based off of emotion. So I think that's one of the greatest things inside the quantitative world that I would say is a big advantage over a discretionary trader.
Now, in other conversations, you've mentioned to me Richard Dennis a lot. Talk to me about why he's been such a big influence in you and your trading.
I loved Richard Dennis. His career is absolutely fascinating to me. Just from everything. Being raised on the south side of Chicago, he didn't have a silver spoon fed to him at all. 100% self-made. I have a tremendous degree of respect for Richard Dennis. It's just amazing what he was able to do in 1986. He literally, took 200 million out of the markets, and he could be down $10 million. He was down $10 million in a day. And just the iron stomach that he had, like what I found fascinating about him, he's known as the Prince of the Pits. And what's really interesting is, a lot of other traders, would get up in the morning and they would read and they'd spend all this time kind of getting ready for the trading day. And he would wait. He would sleep in to the very last minute. He'd get to the floor. He'd trade, and he would just the way that he would approach the markets, like he just had such an amazing ability to think like the house. Like a poker player, right? So he would think at such a strong mental state that it just is overwhelmingly like mind-boggling to me, the stuff that he was able to go throughout his career. And I would attribute him. At first I didn't even know who he was. Because I started as a college intern in a hedge fund. But as I started getting into quantitative trading and analysis, I started to read books like The Way of the Turtle and, different things about Richard Dennis. And I started to learn a lot about just how he would approach the markets and how he would read, psychology and study different things, like philosophy. And he would use that inside of his trading. So I think he's a fascinating figure. If anyone's new to trading, he's definitely worth reading about. He's absolutely someone that I look up to. I just love the way that he defied all the odds, went completely against the grain, and became one of the most successful traders. Really a legendary trader, if you ask me.
Yeah, great stuff, Drew. I've got some rapid fire questions next if you're ready for those. All right, everybody, our rapid fire segment is sponsored by Trading Technologies. Access the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. And now you can trade cryptocurrency spot and derivative markets side by side. For more information, please visit tradingtechnologies.com. First question, pretty sure I'm going to know the answer to this one. What trader has influenced your life the most and why?
Oh, I would say Richard Dennis, without a doubt. His story is, although different than mine, I can really relate to. I didn't come from much, even though I was raised in Naples, Florida. I wasn't given a handful of connections, and neither was Richard Dennis. And what he was able to do with nothing is not only inspirational to me, it's very impressive. He was able to take from nothing. He failed an accounting class, and I actually, even though I am a quant, I got a D in my accounting class in college. So because I didn't pay attention, but I found him very fascinating and inspiring. I'm still inspired by Richard Dennis to this day.
What was one of the hardest things that you've had to overcome in trading?
This is something that I think we've talked about before. Really, what I'd call Russian roulette. Curve fitting is absolutely detrimental to any type of trading firm or fund, if you will. And I got an internship, and then I ended up joining a fund as an employee. And fortunately, I was not on the trading side. And this fund, the principals in this fund, decided to curve fit systems. And what I mean by curve fitting systems is that they would literally go back and they would use back testing during certain periods, and then they would change up their systems and use two different types of systems on the markets. And it ended up going their fund ended up going into a multi-year 60% drawdown. And that was probably the hardest point of my entire career, from the standpoint that I was client facing, and I got to deal with a lot of the clients and try to walk them through the understanding of a drawdown and recovery periods. But the truth of the matter is, if you curve fit a system, you can literally put your fund out of business. And so that's exactly what happened to this fund that I was a part of. And, it was a really negative experience in many respects. But I look back on that time, and this was back in 2010 is when this happened. So, about 8-9 years ago. And it was really, it seemed like such a negative notch on my belt. But fortunately, again, I wasn't on the trading side, so I didn't really have to worry about it too much. But I did really care about the clients inside of the portfolio, and having to sit there and to deal with that, being client facing in a fund that's going through a 60% drawdown over a few years, was very tough. And ultimately, that fund ended up having to unwind because of the poor decisions of the principals.
How has your trading process evolved over the years?
That's a great question. I would say it's become substantially more disciplined.
What is one attribute that you believe every trader should have?
This is going to sound a little strange. Discipline over motivation. A good friend of mine says that motivation is temporary, but discipline is for life. And it's very easy as a trader to be motivated to make trades. Maybe you made a bad trade before or a good trade before, and you have a motivation that's a temporary factor. And the discipline to approach the markets, being rules-based, is probably the number one piece of advice that I think every trader should follow.
What's your favorite book about trading or the markets?
Way of the Turtle. Fantastic book.
Favorite movie or TV show about trading or the markets?
The movie Trader. It's an old movie. Came out in 87, actually, about Paul Tudor Jones. Great movie.
What's the best piece of advice that you've received about trading or the markets?
Sweat the action, not the result. One of the things that I'll say about that is, you're going to have losses in trading. Even as a quant, we have losses. The statistics and the probability and the statistics of losing in trading, you will have losers. But it's how you do throughout the entire frame of reference of time that you're looking for. And I just say sweat the action, not the results.
If you can give a piece of advice to the younger you, what would it be?
I would say journal everything that you're trading, why you're trading it, and review your work every single month, every single week, every quarter, every year, because you're not going to be able to improve if you don't study the reasons for your trades, both the positive trades and the negative trades.
Last question for today, Drew. What's your favorite thing to do when you're not trading?
I like to spend a lot of time with my family. I have a beautiful wife and two young daughters, and I'm also a power lifter, so I do a lot of barbell training in my spare time, and we also like to travel around the world when we're not in the office.
Yeah, you really do. You have a beautiful family. I always look forward to seeing those pictures. You're always in the Cayman Islands, Drew.
We are in the Caymans. We do a lot of work down in the Cayman Islands, have a lot of great friends down there, and we like to spend as much time in the sun as we possibly can.
All right, Drew, where can people find you on Twitter, and give us a website to check out?
You can check out my company at microquant.com, MicroQuant.com. My Twitter handle is Drew Day, and those are the two places to find me.
Drew, thank you so much for coming on Futures Radio Show today.
Thanks for having me, Anthony. I really enjoyed it.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.